Good day, ladies and gentlemen. Welcome to the April 1st edition of the MIF panel broadcast. I'm joined today by Gwen Preston, Jay Taylor, and Brian London. The idea behind today's broadcast is really just to give all of you an overview of where I think we're at now in the markets. We did try to split up the topics a little bit so there would be less overlap, hopefully. And part of the outcome of that is you may see some of us not talking about certain aspects of the market you're most interested in, but we basically did that so we're not just all going over the same material 4 times. The order of presentation will be Jay Taylor, then me, then Gwen, then Brian. If you're not used to using this webinar setup, I just want to point out that on the right side of your screen, it should be the right side, there is a box that's got commands. You can open that up. One of the commands there is the chat box, which you can use to send questions to me. The questions that you send in will come to me. I will sort of agglomerate those. I'll try to spread them around among the different speakers. I mean, I've already got questions so far for 1 or 2 for everybody. I will point out that not everybody's question is going to be answered. I'm already up to a fairly high question total, and I'm pretty sure there's a lot more coming. So we will try to kind of stretch this out and deal with as many questions as we can. But please don't expect us to answer every question individually. There just isn't going to be time. So without further ado, I'm going to pass the screen to my friend Jay, who is going to do the first of 4 presentations. Over to you, Jay.
Good. There we go.
There you go. Yep.
And let's see. Looking for my screen. Where am I? Thought I had this open. Here we go. Okay, there we are. All right, well, this is a picture I like to start my my presentations off with, in part because I think it depicts the big question in my mind is during a storm, and I think everybody would agree we're in quite a storm right now, financially and otherwise. Where will people go for cover? Where will they go to seek safety, safe haven? Will it be treasuries, as is usually the case, or will the people determine that maybe that's not the best? Maybe they should have some gold. And so, of course, treasuries have made an awful lot of sense since 1980. I remember it very well. My first mortgage was a 17.5% mortgage. Interest rates spiked. We had an inflation and a threat to the dollar. Paul Volcker slammed on the brakes and would not allow money to grow. The interest rates went to where they had to be to fund the US, and the rest of the world was telling the United States, if you didn't shape up and be responsible with your monetary behavior, we will trash the dollar. So Volcker slammed on the brakes, and he really bought us a couple of decades of prosperity, I would say, by really allowing Americans to save money. There was an incentive to save. With those kind of interest rates, you get 12, 13, 14% on treasuries, risk-free, and that set the table for what we've seen, a decline in interest rates since then, because we've thrown quite a party over the last couple of decades. Lots and lots of money was created out of thin air, but with that came debt, and the debt has grown much more rapidly than GDP. And so what that's meant with each major cycle, each major credit cycle, there's been more debt to GDP, and that has lowered the level at which interest rates could rise before the next problems, illiquidity, started to become a problem. And so the Federal Reserve has had to become more and more active with each cycle, pumping more and more money in faster and faster with each cycle. So not surprisingly, this is a headline from Barron's at the start of, well, in February. how to position the next bull market in bonds, and certainly we have seen interest rates falling more, and so people in bonds have done quite well. And certainly, if there's no one else to buy treasuries, the Fed is right there to do it, and they've demonstrated so far that that's most certainly what they will continue to do. If no one else in the world is interested in buying treasuries, and there's certainly a certain amount of evidence that our friends that used to our strangers, which we've relied on to fund our treasury, they've not been there the way they used to be. They seem not to be recycling export earnings, dollars earned from exports, back into treasuries, which is causing some problems in terms of the surging U.S. debt and treasury borrowing needs. I think a real turning point, and one that has me believing that maybe the days of being able to continue what we've been doing since 1980 may be over, and that's this slide here that shows the nominal US GDP, take away from that gross federal debt. And certainly, I think the Chinese and other countries around the world started losing confidence in the United States monetary system and in the US dollar, and started making plans, especially China, not just to, well, certainly they made noise with the IMF on the world scene, suggesting they needed more of a say at the IMF. And they started, of course, using those export earnings not just to buy treasuries, but to start building up their own infrastructure and setting up their own trading and banking platforms globally to start to compete with the US dollar. Now, I know Eric is going to talk about liquidity, and he'll get down in the weeds and do a much better job than I'm doing. But from 30,000 feet up, I'm looking at something called the global US dollar liquidity. This chart measures the annual year-over-year growth in this US dollar liquidity, which is the St. Louis Fed's monetary base plus foreign holdings of dollars of US treasuries in foreign banks or in US banks, but it's foreign holders of those treasuries. I started following this after the Asian crisis in 1998. Charlie Clow at Merrill Lynch was keeping track of this to try to determine whether there was enough, just to keep a measure on the liquidity, the global liquidity, to determine whether we might anticipate more problems. And so I really watched this closely. I charted every week, and you can see with each of these bubbles, the Greenspan tech bubble, then we had the housing bubble, and then the granddaddy of all so far, and that was the housing bubble, or the Bernanke's bubble, I call it, after the housing bubble, in response to the housing bubble, and some people call it the everything bubble. Well, we've had littler bubbles on the way down, as you can see. I call it the Yellen, the Obama, don't worry, be happy bubbles. And everybody's been having quite a party during those years. Just a little more elaboration on this global US dollar liquidity metric. What you see here is the percentage of foreigners that are part of that metric. So it peaked right before September 2008 at the financial crisis, and then of course the United States started printing money like mad. So the Federal Reserve component of that, or the monetary base component of that, grew very dramatically, and you can see what happened after that. We started seeing a little bit of an increase then. I just lost my picture. We started seeing a little bit of an increase then as the U.S. tried to downsize its balance sheet, as the Fed tried to downsize its balance sheet. But of course, we saw the Powell pivot just recently, and so it's starting to go back up again. I think it's important to see that this measure of liquidity hasn't really grown over the past 6 years. So as the United States tried, as the Fed tried to normalize its balance sheet, we haven't seen this metric grow to any great extent, which I think might explain some of the liquidity problems that are starting to spring up now. So I think that if I use the word cataclysm, I don't think that that's out of place right now with what we're seeing in the jobless numbers. I mean, you can look at all the other crises that we've had going back, way back to 1967, the oil shock and so forth. Nothing compares with this jobless claim number, and there are those that think it will be no better, probably worse, the next report. Goldman Sachs is talking about a Q1 decline in GDP of 9% and a Q2 of 34%. So, I mean, these are numbers that just make your head spin. They don't, I think to use the word cataclysm isn't out of place. Just lost my track again. I think that you, as gold holders of gold, of course, we've always known that those of us gold bugs have known that gold keeps its value. It's a store of value. It's not necessarily something to buy to get rich on, but certainly something to preserve wealth with. And this is the real S&P 500 denominated as measured with gold as opposed to currency. So, you know, the S&P has gone down dramatically relative to gold. Is what this shows us. And gold is holding up. It's doing its job very nicely. But of course, gold is up this period that I've got on the screen, or the period from February 20th to March 27th. The gold is up a bit. It's holding its own, let's say. But GDX and of course GDXJ have gotten really smashed very hard, even GDXJ even harder than the S&P 500. I believe that will change, but at least for now, the gold is certainly preserving wealth. I think we can't look at this time now without, and maybe it's easier for me because I'm the oldest guy on this panel, I think, by quite a ways. I can remember when we still had a gold standard. So I can remember when times were different and how people thought differently. My parents wouldn't have dreamed of going into debt to buy things. I remember when the first credit cards were issued, and you know, people that in my family and my circles were saying they didn't think it was a good idea. Well, maybe it's okay to buy gas. We can use credit cards. We'll use our Getty card to buy gas, but then you should pay it off right away. The point of this is Machiavelli observed these social cycles. Hard times breeds virtue. It gives birth to fortune and tranquility, but then people get easy. They have an easy life. Tranquility leads to leisure. Leisure leads to disorder. Disorder to ruin. And then from ruin, the cycle can start again. But it's not easy during those difficult times. So this was something my parents couldn't have foreseen. The helicopter money idea, the idea that you could print your way to prosperity, which of course has been taught to our economics students now for some time. I don't think that it's out of the question that the U.S. could lose its reserve currency status, and if that happens, I think things will become much, much different for us in America. I think that we start to see inflation as a very serious problem. I hope this isn't going to happen, but I think it's a very real possibility. We have seen a great deal of volatility recently in the gold markets, and of course in all other markets, certainly the share markets, the gold share markets too. My friend Dan Oliver, who I frequently have on my show of Mermican Capital, put this quote in his newsletter: "Hubris in the gold trade is exhibited not by assuredly predicting the ultimate outcome, but by being financially and mentally unprepared for the volatility." In other words, you need to stand firm in your belief that gold will certainly retain its value no matter the volatility. I think Brian is going to talk a little bit about maybe the gold markets and the factors that have caused this volatility in the bullion market. But I think this is the chart that you're seeing there is measuring gold in the Weimar Republic during that hyperinflation. So there was a great deal of volatility and consternation, no doubt, people getting whipped in and out of the markets. But I like to look at this as a sureness of what we can look for. I think whether hyperinflation or deflation, well, I think deflation is most certainly better for gold miners than any kind of massive inflation rate. But you know, if the real price of gold rises relative to the cost of getting it out, as it most certainly did during the Great Depression, people that owned home state lines did very, very well, had huge dividends, and their share price went up dramatically. Whereas, obviously the stock market lost 79% at one point in time. So that's about it for me. I mean, this is a monthly gold chart that I track. It's actually an average price for each month going back to 1995. I think it's as bullish as can be. That's up to date through March 31st. And we're seeing, I think, what should give us assurance as gold holders that gold will stay and will be the place that many, many people seek to hide or seek refuge in this time of storm. So I need to give this back to Eric.
Yeah, the change presenter.
Change presenter, I'm looking for it. Help me, change presenter.
You click on change presenter, you should get a drop down list.
I'm just looking for the screen. I don't see it right now. Change presenter, sharing. Here it is. Okay, sorry. Eric. Okay.
Okay. Hello again, everybody. I'm going to do the next presentation. I'm going to deal largely with, as Jay mentioned, I'm going to talk about liquidity. Liquidity in all its forms is the lifeblood of the markets. And normally, when you see the sort of situation we're in right now, which is a horrendous bear market, obviously, that's usually a measure of liquidity being reduced. We're in, a deleveraging phase, and normally deleveraging phases are marked by individuals, companies, funds struggling to maximize cash reserves, try to get as liquid as possible, hence the word liquidity. And that's having a lot of major impacts. And I think how that unfolds is going to define where the markets go in the short term. And for that reason, that's essentially going to be my topic. I just want to quickly run through my part of the presentation again. I'll start off with this screen here. This is slightly tongue-in-cheek. I hope that the answer to this question is obvious to everyone in the audience. The chart on the right is the S&P. The chart on the left is gold. I think it's pretty obvious which of these two asset classes is in a bull market right now. We're going to see things keep moving around. I personally expect to see a lower low on Wall Street. I do not expect to see a lower low on gold. I think 1450 put in a couple of weeks ago was as bad as it's going to get. My expectation is gold's going to go quite a bit higher. And unfortunately, I think we'll probably see a 50% plus drawdown in Wall Street before this bear market's all said and done. I wanted to talk about leverage today because it's at the center of a lot of what's happening, in my opinion. Leverage, as I'm sure you know, is just using borrowed capital to increase the effective size of the investment and the returns on that investment. Obviously, if your trade goes the right way, if you're using a lot of other people's money, you could magnify the returns on that investment. It's wise to remember, and many are being reminded right now, that it's a two-way street, of course. If things go down, the leverage also increases your losses, and you can get into a very bad place very quickly. Normally, when we see markets entering a bear market, one of the first things you see is entities of all types trying to reduce their leverage, get liquid, get into the biggest, most liquid markets that they can. If you look back to the last big crisis, the great financial crisis, as it was then called, this one may end up being a new one. In 2009, investment banks, commercial banks were using leverage ratios up to 50, borrowing 98% of the money when they were setting up these collateralized debt obligations and the trades around them. That was also matched in large part by millions of retail consumers who were using the same kind of leverage, maybe without thinking about it, when they had mortgages, second mortgages, lines of credit,
that where they were basically borrowing 98%, 100%, or more than 100% of the value of their homes. This is, of course, done on the assumption real estate prices never go down. They did, in fact, go down quite a bit, and when that happened, it basically turned into a negative feedback loop, and that's what you see during periods of deleveraging, is these negative feedback loops where selling is driving prices down, which is forcing more selling, and it just goes on and on and on until the leverage comes down to a level where the financial system can deal with it. In response to the last crisis, we saw a lot of legislative changes. One of those was the Dodd-Frank Act, and what a lot of these laws have done is impose more restrictions on banks and investment banks. They have to have larger reserves. They essentially aren't allowed to lift their leverage to the kind of levels you saw during the last crisis. Although what seems to have happened here is, although I think there is less leverage overall, it simply got passed to different parties like hedge funds, special purpose vehicles, private investment groups, private equity groups that were setting up their own structured products, a lot of which also have high leverage ratios. There's, I think, less overall than last time, but it's a lot harder to track because a lot of more of this stuff is really in sort of in private hands. It's not in public vehicles where you see immediate reaction in terms of share prices with these vehicles themselves. But we are seeing it, of course, with price swings and volatility as selling is ongoing and parties of all types are basically going to cash. To give you a sense of scale here, and this is a very, this chart's a bit of a guesstimate, really. It was put together by Bank of America, but this shows you several bubbles that happened over the last 5 decades. Gold was one, Nikkei, of course, was one in the 80s, then came tech, then the US housing bubble, and now we've got what's referred to as a disruptor bubble. You think of FANG stocks and all the other stocks that go with them, but also a lot of new products on the financial sector where you've seen a lot of leverage added to the mix. In the last few years, most of the increase in borrowing, increase in leverage hasn't been happening in investment banks so much. It's really been happening on the business side. US businesses increased their borrowing in the last few years by about 6 trillion. They're up to an overall level of about 16 trillion right now. That may have actually gone up a bit in the last month. Any large corporation that had lines of credit or other existing loans where they were able to bulk those loans up, pretty much everyone that could do it has done it in the last month to try to give themselves a cushion. So that, in that sense, at least, the leverage may have gone up, although at the same time, you're obviously seeing selling from other parties to try to get rid of their leverage. One of the issues that I've got with the overall debt levels going up at a corporate level, or one concern, one potential red flag here, is a lot of this new debt was not, highest rated AAA stuff. If you look at the chart on the right here, this shows you U.S. corporate bonds segmented by different risk levels. You can see here that the biggest tranche right now by far is what's called triple B. Triple B is the lowest investment grade. The problem that we may potentially have here, in fact, we will have it, I think, is that as the financials of various and sundry companies get worse during this crisis, you're going to see debt downgrades. Once you drop below triple B, you're going into junk bond status. That's a big problem because the junk bond market is simply not as large as the overall institutional investment grade market is. It's going to be very difficult for the bond market to absorb these bonds if we see a large percentage of these triple Bs dropping down to junk. I don't really think the market can absorb them other than through lower prices. It's just not a big enough market because most institutions either have strict limits or they simply cannot own junk bonds. So we're likely to see a lot of downward movement in prices at the riskier end of the bond scale. And I think we'll probably see a number of bond defaults by corporations and some of them potentially large ones. To give you some idea how these different markets have been moving, these are 10+ year charts. The chart on the top is LQD. That's essentially the investment grade corporate bond ETF. The lower chart is JNK, which is a junk bond ETF. If you take a look at how these two have moved, and of course, if you look at the long-term chart, these are both bull markets. The bonds market overall has been in a bull market for about 30 years now, been going lower left to upper right. That sort of ended in the last month when the proverbial shit hit the fan. You can see there was a big sell-off in LQD, but it's come back quite a bit. Right now, it's off about 6.5% from its highs. Junk market, on the other hand, also saw a sell-off. It's come back, but not nearly as much. And right now, it's down 17%. In other words, a loss in value. And keep in mind, these are price indexes. So as the price drops, the effective yield of the bond goes up. It becomes more expensive, and anyone, not that I think you could do it right now, but anyone trying to issue in either of these markets right now is going to be paying these sort of the new yields that you're seeing the market define, or the yields these new issues are probably going to have to be paying. Junks come off 17%. I suspect we're going to see this divergence continue to get worse over the next month or two, maybe more, as more stuff is downgraded. And we're not even seeing yet the impact of all these triple Bs dropping into the junk bond space, which I believe is going to happen. Now, in order to try to forestall this problem and reduce the dislocations, what we've seen is government, mainly in two forms, either the Fed or other central banks or governments themselves. You're seeing a huge amount of monetary stimulus. The Fed's increasing its balance sheet very rapidly. It's doing direct purchases of treasuries to try to lift that the highest end of the market up and drive yields down. They've also opened up new facilities in the last couple of weeks to buy mortgage products, to buy direct corporate bonds. They're essentially trying to be the bid under the market here, give leverage players a chance to exit, and try to ensure that these markets don't basically just blow up in everyone's face. At the same time, the government itself is undertaking fiscal stimulus. That's direct government spending. You know, think of all those $1,200 checks that are going out in the US, tax abatements and deferrals, which we'll probably see, a lot of direct transfers to states and municipalities who have a more difficult time raising money during periods like this. Essentially, between these two items, I think we see the Fed balance sheet get 10 trillion by the end of the year. It might actually be more than that, given that they're talking about unlimited QE effectively. Federal deficit, I think, gets to probably minimum 3 trillion. I don't see how it's going to be less than that, given the impacts we were already seeing with the deficit growing last year. That's just been exacerbated by these new stimulus packages, loss of tax revenue. They could easily get to 3 or 4 trillion this year. I think it's extremely unlikely that we've seen the end of either of the new Fed maneuvers. There's not a lot left in their toolbox, but they can certainly increase QE more. I think it's highly likely, unless the COVID crisis abates very quickly, we're going to see at least one more stimulus package out of Washington. So these numbers I just talked about, if anything, the likelihood is they're going to be bigger than I think, not smaller. There's a huge, huge, huge amount of new debt being created at the government level. Essentially, the private leverage is being shifted to public leverage. That's what's going on right now. If you want to see some of the impacts of this, you take a look at these two charts. The one on the right is the TNX, which is a 10-year yield. That's dived to levels we've never seen in history. It actually got down to 0.4%. It's sitting right now at about let me see here. It's sitting at about 0.6. That is a fairly amazing number, but it's basically because of two things. Obviously, it's partially because the Fed cut rates to effectively zero, but it's also a measure of the activity you're seeing the Fed undertake in terms of QE and being the bid under the Treasury market. They're buying Treasuries to keep the yields down at the same time as other parties are probably also buying Treasuries because they're considered about the safest instrument out there. But you're also seeing foreigners selling and other institutions that want to go to literally cash buying, also getting out of Treasuries to go to cash. The US dollars, the chart on the left side, you can see how big the bar is on the right side of that chart. There's been some enormous moves in the currency market. US dollar shot up to about 103, 104, pulled back to about 96. It's now sitting at about 99. I I think that, there is danger of the US dollar index going higher. There is a shortage of dollars out there right now. The Fed's trying to alleviate that. They put up these swap lines to a bunch of other central banks, which essentially allows those central banks to swap their currencies for dollars, which they can sell into the market and supply dollars overseas. They've also set up a new facility a couple of days ago that allows central banks who have treasuries on deposit with the US Fed. It allows those central banks to use those as collateral to borrow dollars. Essentially, the Fed's trying to supply dollars to the market, trying to supply dollars to other central banks that can then sell them, because it's really, nobody wants to see a US dollar shooting up. It creates a myriad of problems. It's not a good thing at any level. I think, and I hope what we're going to see here longer term is these things will be successful. Ultimately, I think the U.S. dollar index is going to go lower, but we may see more spikes like the one we just saw in the meantime. Ultimately, I think it goes lower, but in the short term, it could go either way. I'd like to tell you there's a good roadmap here, but there's not. There's no. This really doesn't match any financial crisis that we've been through before. The recession that I think was on its way before, I said months ago that I thought we'd have a recession this year. Obviously, this crisis has magnified things incredibly. We're going to see GDP numbers, unemployment numbers like we've never seen before or even imagined in our worst nightmares. Our best hope is that this is a recession with very large amplitude but short duration. We just don't know yet. I suspect that's what's going to happen, is that we'll get through this COVID crisis relatively quickly in the space of a few months. What we don't know yet is what the ongoing knock-on effects are going to be, because there's definitely going to be business closures. There's going to be unemployment that doesn't bounce back. Obviously, the fiscal situation of most governments is going to be a nightmare. They're all going to run huge deficits. Right now, I think we're coming to the end, I hope, of what I call the liquidity seeking margin call phase of this bear market. You see this early in most bear markets where people are just saying, get me the hell out of here. They want to get out of anything but the absolute safest investments. They want to go to cash. They want to go to treasuries. They just want to be out of the market altogether. That phase tends to be at its most severe when we see these steep drops early in a bear market, which we've obviously seen. This was the quickest drop ever. I'm hoping now that we're passing into the insolvency phase. Not that that's going to be fun either, but this is a phase where people stop being concerned about just getting out of the market and getting rid of margin. Those margin calls are done. Then everyone starts trying to price in what's the future look like, how many business failures, job losses do we see, how fast is GDP going to bounce back. That's where the market is going to shift around trying to price that. I don't think, I only think part of the GDP, unemployment, and business closure situation has been priced in. I do think we see a bigger drawdown. I think Wall Street ultimately has a 50% plus drawdown. It's going to take a few months for that to actually come to pass. I think the bottom will be relatively quick, but I just don't know how fast we're going to come out of it. Governments are doing what they can. I mean, right now it's all hands on deck, every finger in the dike. That's going to be the case until the COVID outbreak peaks and everyone's comfortable we're coming down the other side of it, and hopefully we can get rid of the restrictions. But until that happens, we're just going to see more and more fiscal stimulus, more and more monetary stimulus. The combination of all those things is going to add inconceivable amounts to both the Fed balance sheet and to the government debt levels. I don't think there's any way this gets paid back using traditional channels. There's no way it's going to get done with tax increases anytime in the near or medium future. I don't see governments being willing or able to do enough cost cutting. So essentially, we've got high odds of perhaps a debt jubilee where basically a bunch of different debts get written off. I don't see that happening at a government level. I don't see the US government or any other G8 government literally defaulting on the debt. I think what they will do, and I think what's coming as an end game, is some sort of long run era of negative real rates. I think we may see central banks cap the yield on government bonds, which will effectively cap all the bonds that are under them. They'll also be pushing as hard as they can, either through straight QE, straight money printing. They're going to try to generate inflation. The best potential outcome for them is to cap rates, generate inflation, generate large negative interest rates. That means that over time, current debt will get paid back with cheaper and cheaper dollars. So in effect, it's a soft default, but it's not a default that appears that painful or that hurtful, and more to the point, doesn't get them thrown out of office. The only good news I can tell you out of that is that if you wanted to sit down and dream up and game the best scenario for precious metals and anything else that really is outside the financial system, think of Bitcoin, some other hard assets, things that have no counterparty. This is essentially the best scenario you could imagine for that type of assets, which is why I think gold's going a lot higher. Understand I'm not personally a gold bug, but I've already called for, I think, $2,000 gold this year. It could hit it well before the end of the year. I think over the next 12 to 24 to 36 months, it's quite possible we see gold in the high 2000s. Silver will get pulled along with it, as will other precious metals. I think during the next year or two, the gold sector on the equity side is going to be the best performing sector. I think it's the area where you want to be. I'm not saying this is low risk. Nothing's going to be low risk for the next little while. It's going to be high volatility for everybody going forward for some time. But I think the gold space is the place to be.
Hello, everyone. I hope that you can hear me. Can people let me know, maybe a thumbs up or something if you can hear me?
I can. Yeah.
Perfect. That's great, because it was challenging hearing Eric. I think it's a connectivity issue. Certainly one of the things about all of us working from home, so many people working from home, is that bandwidths are maxed out. So that may well have been a big part of what was going on there. Hopefully, whatever service I'm using works better. Let me jump right in here. Here's my title: A Health Crisis, an Economic Catastrophe, a Golden Opportunity. I'm not going to spend a lot of time going through what has happened. We've all been watching it incessantly, but the take-home point is that this crash happened with historic scale and speed, and there was reason for that. The factors that drove it are unprecedented. Things like consumer spending declining almost by half and by 90% in some key categories like travel. We've seen this massive unemployment claims chart already. I mean, it puts the Great Depression to shame. We're expecting US GDP contractions of 30% in the second quarter on top of it. And one of the things that meant that the initial market crash was perhaps even more severe was the oil price war that is also happening. It's not helping by any means. And then we have these, global supply chains are destroyed, and the widespreadness of the impact here is important. I mean, think about Facebook and Google. Where do they get their ad revenue from? Well, a lot of it is from resorts and travel companies and restaurants and all kinds of businesses that will not be spending money on advertising because they're shut down for goodness knows how long. So the widespreadness of the impact here is very important. Now, what I want to talk about right now is, where are we going? Where do I think we are going? And that means the broad markets, and then, of course, the gold space. So within that, the question is, of course, what shape is that going to look like? Oh, sorry, I didn't mean to change things there. I think that an important distinction here is that this started certainly as an event-based crash. Then we added in an oil price war, and we added in the layers of concern, like a very weak, zombie-laden corporate debt market. And we had the potential for this to become a structural recession instead of just an event-based recession. The important thing that happened then was unprecedented monetary and fiscal response. The Federal Reserve has nationalized the market. Obviously, Eric was talking about this. There are pros and cons. There are things down the road that this will undeniably impact in massive ways. But in the moment, what matters is that the Fed is going to buy as much as needed of everything except for equities and high yield debt to keep things functioning. And that really matters, because that means that investors feel supported in the market, There is no longer a broad-based expectation that, for instance, the corporate debt bubble will burst and turn this into something even worse than it already is. So that's really important, and is helping certainly in the moment. I think the fact that the great financial crisis was not that long ago helps in that investors have clear memory of how much big fiscal measures or big monetary measures really turned that that crash, or helped that crash stabilize. And then, of course, we have the fiscal package, over $1 trillion in America to help Main Street. The scale of those packages are really important. So right now, because of those two, we have this sense of support for investors and businesses. Now, just because that's there, I don't think we're anywhere near out of the woods yet. Right now, we have this excitement over infinite quantitative easing, and that has markets rising. But I do not think it's possible for markets to keep rising through the flood of terrible data that's coming. Every aspect of data that you can think of looking forward pretty turn really dark soon. Of course, data is by its nature lagging. We need the week or the month to end, or the quarter, before we count what happened. So it's lagging. We just have seen the first of that with that jobless claims number. But for instance, Ray Dalio, I mean, he's a very respected analyst of these sorts of things. He thinks corporate losses from the crisis will top $4 trillion. That's 20% of GDP in losses. So that's the kind of terrible data that is still to come. And that's why I certainly think we're looking at a downward sloping W. I think we're going to have another bottom. I think it's going to take a lot longer to get there, and it's going to be lower. And so we're certainly not out of the woods yet. That's the economic side. On the virus side, darker days are definitely ahead. This is a great chart that the Financial Times updates every day, showing the confirmed number of cases in each country in the past week by the number of days since there were 200 new cases in 1 week. So that's sort of considered the starting point of an outbreak in a particular country, and it shows the trajectories for those countries. We can certainly see where America is on that line. And it's optimistic to think that everybody will track the way China did. Italy, you can see that its curve had a slightly slower ascent, but lasted, its peak is longer. And I think that is because the lockdown measures in China had very broad-based adherence. That's what happens in a country with the ruling regime that China has. We do not have that kind of response in most parts of America. And so there's definitely reason to believe that the top in America will be higher and will take longer to play out. So there's a lot of bad data yet to come. That's why I think the broad markets are looking at a downward sloping and right side extended W. There's this description you've ever heard. Letter. Okay, so that's sure what is the pattern for gold in a key way. Before this packages, I was very hesitant to be interested in gold again, because I did not think that there was a critical mass of investors who were interested in buying anything while that panic was ongoing. Once that panic, that period of panic eased because of these massive stimulus packages, I think the game changed for gold, and there is that critical mass of investors now willing to back the yellow metal. And in fact, what we're in is what I think of as a perfect storm for gold. And there's sort of three fundamental reasons. There's more, but three that I think I'm going to focus on here. First of all, bottom pickers know that gold bottoms first in these sorts of crises. The tables or the charts on the right side here show gold outperforming out of what was a fairly moderate crash, which was the late 2018 stock market crash, and then also out of the global financial crisis. And you can see that gold, which is in red in both charts, bottomed first and therefore dramatically outperformed the S&P in those scenarios. So there's a lot of money sitting on the sidelines after this massive gold bull, or massive bull market in the broad space. that wants to jump into this opportunity. And those bottom pickers know that gold bottoms first. So that encourages them to move into the yellow metal. Then you layer in fundamentally bullish support for gold, which is infinite money printing and very negative real rates. Those support gold always. And then you have the fact that gold miners are making very good money at current gold prices, and that will only improve as gold rises from here. So as people rotate back into buying over the next while, gold miners are going to stand out across equities because they will offer strong balance sheets, strong cash flows, and that leverage to a rising gold price. This table down here at the bottom just shows average expected earnings for some of the majors out there. And you can see that they're nice, strong numbers. That's only obviously one small capture of those numbers, but I think gold miners will stand out across equities. So I do think that there's a perfect storm set up here for gold. So I just said that the broad markets have another bottom coming that's going to be lower. It's going to take longer. It's not good. There's all this terrible data. And then I said that gold is set up to perform. So how do those connect? So how can gold survive what's coming in the big picture? I think that depends on two things. First, it depends how strongly gold can trade before markets start sliding down again, because the better the gold trade is established, the more gold represents a hedge to investors on down days rather than just something to sell to grab cash. And I think the other key factor is whether we get to the next bottom through a sudden steep drop, like we saw largely take us down in March to this first bottom, or through a more consistent downward slide. When you get those sharp, steep corrections, you get panic, and panicked investors sell everything, hedges be damned. When you have a more sustained downward step based on incoming data and a better understanding of what's going on, there's an opportunity there for gold to perform as a hedge rather than to be sold as the baby in the bathwater. That's not how the saying goes, but you know what I mean. So those, I think, are the two key factors. We cannot answer either. We can't know for sure how either is going to work. I do think that there's reason to believe that we're past peak panic. I talked about this in a letter that I sent out yesterday. What we went through in accepting that coronavirus had changed the globe is nothing less than a paradigm shift, and it's very difficult for people to accept paradigm shifts. And so it was very difficult for us to all accept the scale and the severity of impact of what was going on. That's why now there's of what's going on. We don't like it. There's still a lot of shifting of patterns and all of these things and expectations, but we understand in general what's going on. So I think there's reason to believe that those panic moments are largely behind us, which suggests we will step down into the next bottom, not with those steep drops, which improves gold's odds of performing. Big picture wise, the rally from this crash will give gold investors incredible gains. That, of course, leads directly to the question, so when do we enter and what do we enter? And my answer to that is that you need to devise your plan. The first question in that is, are you a trader or are you an investor? And that's really important right now because I open up my screen every day, I see what's going on with the big markets, and I see what's going on with GDX because and gold, because I'm just curious to know what's happening in the moment. But there's a problem with that, which is that when I see GDX gaining 11% on a day, and this was before I had re-entered at all, I got a lot of anxiety. Am I missing it? But then you have to step back. I'm an investor. I am not a day trader. And if I'm an investor, I need to ignore daily moves. I can use daily moves to help me inform my outlook for where the markets are going, but I cannot try and play daily moves because you have to be a focused day trader if you want to do that. Instead, if you're an investor, you should develop a plan for how and what to enter based on your broad outlook, and then you should execute that plan. And that alleviates you from the stress of from worrying about these daily ups and downs, which will persist for quite some time. The volatility in gold and in the markets through the bottoming process of the great financial crisis was extreme. And so you can really give yourself a lot of anxiety, fear of missing out, and those sorts of things if you worry like a day trader when you're actually an investor. That's my first comment, is know whether you're a trader or an investor. I'm an investor. Your options, I think, if you're a gold investor, you can either start entering now, or you can wait until we're past that second bottom, or whatever sign we get that gold is clearly moving up. I put together this little table to just sort of summarize what I see in those two paths. If you start buying now, you have the advantage that you might be picking the bottom, more closely entering at the bottom. Of course, the risk is that gold does get dragged down again as we get to the other side of this W in the broad markets. If you're going to start on that path, do not enter all in one day. Don't pretend that you can pick the best moment. So buy in tranches, consider stink bids in case gold does get dragged down in that W. Be steady and structured in how you enter the market if you're going to start entering now. The other option is to wait until it's more apparent that gold is on the upside, whether it survives the next side of this W rising, or whether it gets dragged down and then rises from there. Advantage of that is, of course, less risk. The downside of that entry is that you will miss the bottom. That's the essence of this stance. But the risk is much lower, and if you want to just buy in one go and not have to worry about such a structured entry plan, then you can do that. So that's my broad outline of sort of when to enter. As for what to enter, I really think that it makes sense to ride the tide at the beginning. So gold majors and royalty companies are the first to get bought when generalist money rotates into gold. Right now, there's a caveat to that rule of thumb, which is that you want to exclude companies that have been significantly impacted by mine suspensions. So there are companies out there, Pan American Silver, unfortunately, is one of them. More than half of their output is shut down, and it's very uncertain when that will start up again. Pan American Silver will absolutely survive, and it will do well in the precious metals market that is to come, but it probably won't do well first because it's disproportionately affected by mine suspension. So you just want to exclude companies that are disproportionately affected in that way. I would say you also want to move down the food chain either now or in a little while, perhaps after the bottom of that second half of that W, into the next tier, which is sort of developers and optionality plays. If you are a high-risk gold investor, I think it's also worth remembering that there are likely to be some pretty interesting financing opportunities in May or June for good explorers that need cash and do not want to miss the summer season. Their share prices will not have strengthened by then, but if gold looks like it has bottomed and will be moving up in some months time frame, they won't want to miss this exploration season completely and be sort of dead in the water as the gold market gets going. So there will probably be lots of opportunities to participate in financings for gold explorers who need money and who are at very inexpensive entry points. So that's for the more aggressive of the investors out there. This chart is dated, but I just love it as a reminder of what happens when generalist dollars pour into the gold sector. It is a tiny sector. We focus on it, but it is a really small space. Prices really rise when generalist dollars arrive, and they will arrive because the COVID crisis is only making gold's strong fundamentals. They were strong before this all happened, and now they're way stronger. So precious metals and precious metal stocks will shine, but I think each person just has to really come up with a plan for how you want to participate in this, and then really stick to that plan. Don't decide whether you're a trader or an investor. Come up with a plan and execute that plan. It's important to come up with that plan at times like now when things are looking somewhat stable, as opposed to trying to make decisions on terrible days. Okay, that's all I'm going to say for now. I'm going to hand it over to Brian, who is going to take us through, I think, some more facets of what's going on with the physical gold market.
Thank you, Gwen. I believe I am showing my screen now.
Yep.
I'd like to thank everybody for these great comments, for my fellow panelists. They really good comments, kind of increased the pressure on me to say something smart and different. I think I'll achieve the different part. We'll see about the smart part. My presentation, or the crux of my presentation really is that the gold market, this new gold bull market is coming at us fast and hard now, much more quickly than we thought was going to happen before. I had been predicting, pardon this going back and forth, I had been predicting that over the next 3 to 5 years or so, the Fed would have to at some point lower rates back to zero, that they would have a return to quantitative easing, but this time, because the patient had developed a certain tolerance to the drug, that the quantitative easing would have to be much greater than before. I also expected that this time the Fed asset purchases would expand to corporate debt and perhaps even equities at some point. And I also expected that this time around we'd have to have fiscal stimulus measures by the government, and more fiscal stimulus than we saw after the 2008 crisis. That was kind of a puny stimulus a bill or stimulus effort back then, some $850 billion. And at this time, the efforts would dwarf that. Now, instead of 3 to 5 years, all of this has come to pass in not much more than 5 days. And that's the real thing that we're all trying to get a hold of right now and try and get our minds around, is that this kind of long-term monetary reflation, this massive tsunami of liquidity that I believe I and all of our panelists expected to see over the next few years, it's just happened in a flash. It's just been shocking and overwhelming and awe-inspiring, and it's going to flood onto the markets now, and it's going to have very real implications. So let's look back and see, despite the fact that this is happening a good bit more quickly than what we saw in 2008. Let's look back and see if we can draw some lessons from back then. For one, this chart looks at the immediate aftermath of the 2008 financial crisis. It looks at gold and gold's performance. As you can see, there's some very significant volatility early on, and really for the first few months following the onset of the 2008 financial crisis. Gold would rise tremendously and fall the next day, and back and forth. And that was a phase that the metal went through. That was a liquidity crunch, a liquidity crisis within the greater financial crisis. And what happened then was that speculators and investors needed cash, or they simply wanted to go to cash, and they were selling everything, anything that wasn't nailed down. And gold performed its role. A lot of people look back at that and said that gold didn't rise, and therefore it didn't provide this safe haven. But in fact, in my view, it really did, because gold operates as the safe haven, the piggy bank that you can go to in times of crisis, and it did so then. Speculators facing margin calls and needing to raise cash, they broke open that piggy bank and were able to get the cash. So gold served its role as insurance in times of trouble. And as we've seen, that's happened again in this most recent financial crisis. We've gotten that kind of, we've had that liquidity crunch. We've seen the gold price plummet and rebound and plummet again. And we've seen that kind of volatility. Now, what we look at here in immediately following 2008 is this period actually lasted for a few months where we had that kind of volatility. Now, of course, everything's happening more quickly now, so we'll see how that plays out. But the point here, I think, is that we shouldn't be disheartened by this kind of volatility in gold, and that our next chart shows what the potential is. This fear that peaked in the immediate aftermath of the 2008 crisis turned to greed as investors bought gold in reaction and began to appreciate the unprecedented monetary stimulus that the Fed and other central banks were bringing to the markets. And the result was that over the next couple of years, the gold more than doubled in price, close to 2.5 times it rose in price, and mining shares, by and large, leveraged those gains. So that's what happened in back then. And as the investors began to appreciate the scale of this kind of liquidity, this kind of monetary reflation that the central banks were bringing to the markets. And now we're seeing not only that kind of liquidity, but coming more quickly. Now, it's important for us to also realize that a new round of massive stimulus was already baked into the cake. The central banks had created this monster, and now they had to feed it. Periodically, at some point, at some passage of time, the markets would come back to the Fed and demand another rate cut or more liquidity because they needed it, more cowbell, as it were. And they were going to do that at some point this year. Before this crisis developed, Fed funds futures predicted by an overwhelming margin that we would have one or perhaps two rate cuts this year. Yet there wasn't really anything in the data, nothing on the economic horizon that really pointed to that. But the markets felt that it would have to happen. In my view, that it was going to happen as much as a matter of the passage of time than anything else, and some excuse would be proffered or created for that request for more liquidity. So as I wrote in a recent issue of Gold Newsletter, the coronavirus isn't the reason for the next round of currency creation. It's just the excuse. It only affected the timing of it. It brought that timing forward. Now, it just so happens, not to belittle the effects of the virus, which are obviously historic and severe, it is a very valid excuse and brought all of these measures forward, not only in time, but also in degree. The implementation, the actual start of this liquidity, that was brought forward, but it was accelerated, as I said, in a dramatic fashion over a very short period of time. This chart of total Fed assets shows this period of relative stability in the Fed funds rate, around $4.5 trillion post the rounds of quantitative easing. Then in late 2017, we saw the great unwind, and we saw the Fed assets begin to decrease. The Fed was able to get that down by some 679 billion until earlier, about late last year, they started increasing their asset purchases again. Now, they said it wasn't QE. This was decidedly not QE because it didn't go across the entire Treasury curve in their purchases and include CDOs. But as we see in just the recent days, the printing presses are rolling again. You can see this truly dramatic acceleration over a matter of days to about $5.2 trillion now on the Fed balance sheet. So the new expansion totaled from the bottom in late August of 2019. This latest round of expansion is already about $1.5 trillion, and it's not ending. This is just the start. The Fed's emergency moves, as you can imagine, these brought immediate reactions in the market. And one of the things I'd like to touch on in my presentation are the reactions, the responses, and just and not only the U.S. physical bullion market, but the global paper gold pricing scheme. What we saw about a week and a half ago, or actually the Monday before last, when the Fed came out and announced this quantitative, unlimited quantitative easing, QE infinity, we saw investors immediately rush to market. It didn't help much for the stock market on that day, but bullion demand in the U.S. especially surged. And I don't have a really good line chart or anything to show this, but this table can give you some idea of what happened just with the U.S. Mint bullion sales. As you can see in March, and this is as of March 25th. So when it says last week, that ended March 25th. In some cases, the 1 week of bullion sales, go back, that 1 week of bullion sales exceeded by a large margin the entire months previously of bullion sales. In March in itself, with days left to compile the total, sold 123,000 1-ounce gold coins and essentially wiped out the U.S. Mint's inventory. But what's important to note is that it not only wiped out the U.S. Mint's inventory of current gold bullion coins and current silver bullion coins. It wiped out every available coin in the aftermarket from previous years, backdated coins. There were tremendous amounts, tens of thousands of coins available at any point in time in that market of backdated US bullion coins. All of those were snapped up within a couple of days, 2 to 3 days. Not only that, every available product of the Royal Canadian Mint, every available product of every other foreign mint that was in situ in the United States was snapped up. There was quite literally, there was very little product to be had for anyone seeking to buy gold or silver bullion. And for those that were able to source coins, the prices of those coins soared. For silver coins, the on the street silver price was about $7 an ounce higher than the spot price at the time, and that's not factoring in. That's eliminating the typical $2 premium. So these coins were selling for about $9 an ounce above the spot price. You eliminate that $2 typical premium, and they were selling the on the street spot price for silver was $7 higher than what was being quoted in the paper silver markets. For gold, that premium extended to $60 to $80 an ounce higher than the listed spot price of gold. That's what you had to pay on the street to get gold bullion. Now, a lot of people, a lot of analysts out there attributed much of this, or blamed much of this, if not all of this, on supply disruptions that resulted from refineries being shut down in Europe and around the world, the inability to fly bullion in via airplanes from Europe, from London. And frankly, that's a ridiculous contention, because all of this happened. This huge surge in demand happened before we had refinery shutdowns, while the U.S. Mint was still producing, and it is still producing, and before the Royal Canadian Mint had any real effect on its production levels. So anyone who says this is entirely due to supply disruptions, which are real and are having an effect, as I'll show you in a moment, anyone doing that is really willfully trying to ignore the surge in demand, which is very real, and I think very important, in that U.S. Physical bullion demand has been slacking in recent years, actually since Donald Trump was elected president. And that's because the people who tend to buy gold and silver aren't afraid of Donald Trump. And the people who are afraid of Donald Trump aren't the kinds of people who actually buy gold and silver bullion. So bullion sales slumped in the US since Trump was elected. And only recently, and very recently, and only when the Fed started this massive effort at reinflation of the money supply, only at that point did we see demand for bullion surge in the U.S. And as you can see, it's surged quite significantly. But the other effect came in the paper gold market. As we can see in this chart, this zero hedge chart goes back to the 25th of March and shows what happened on that day and the following day to the paper gold market. And what supposedly happened was that the spot gold price, as set in London, was very unreliable, became very unreliable, because a lot of the market makers had to stay at home. London was on lockdown, and so there was not a reliable way to get a spot price quotation. There were also some supply disruptions, refinery shutdowns, mint shutdowns, and the like that contributed to it, and transportation issues. But primarily the market makers weren't able to provide a reliable spot price. So traders who rely on the spot price were forced to go into the COMEX market and buy near-term futures. What happened there, as you can see in the lower chart, is that the spread between spot gold and nearby futures, which is usually, there is somewhat of a spread, perhaps a $10 spread, it expanded to $60 to $80 in a flash, and the spot price became completely unreliable. Now, as you can see by that that lower chart again, that somewhat normalized now, has somewhat normalized. But the fact remains that this exposed some chinks in the armor, as it were, in the whole paper gold pricing scheme. And as we've seen, COMEX had issues in supplying gold to paper contract holders who stood for delivery. And the issue there, and the excuse given there, is that the gold exists, but it's in the wrong place. There aren't enough 100-ounce bars in the COMEX warehouse, but there are plenty 400-ounce bars in London and kilo bars in London. So the COMEX and the London Bullion Market Association quickly came to an agreement to supply 400-ounce bars and kilo bars to supply those in exchange for people standing for delivery for 100-ounce bars. It's a long, convoluted story, and frankly, if you want to get up to speed on it, I urge you to go to bullionstar.com and read what Ronan Manley has been writing. He's done the best work that I've seen on explaining this issue. But as an aside, one of the things that the COMEX and the LBMA have come up with are these accelerated certificates of exchange called ACEs. In fact, if you had to turn in, if you had two 100-ounce COMEX contracts and you stood for delivery, the COMEX would give you 2 ACEs. There are 4 ACEs for every 400-ounce bars. And this would be a paper representation of a fraction of the 400-ounce bars. And they would take this paper representation and tell you that was physical delivery. So that's how laughable that situation has come. And again, the big picture that I see from this is that there are cracks in the foundation of this whole paper gold pricing scheme. These paper gold prices, as quoted on the futures exchanges, are far lower right now than the on-the-street prices for physical bullion. That I think will that premium I think will come down a bit as some of these supply disruptions are resolved. But the underlying fact is that demand for bullion, in the face of this extraordinary move toward easing by the Fed, demand for bullion is surging, and it's going to stay high, and premiums will stay high to some extent. And further, there is the risk, there's the chance that enough people will stand for delivery in the COMEX market that it will create some severe issues there. I don't think that COMEX will blow up. I think that they could and would at some point simply change the rules and only settle for cash. But just these kinds of stresses on the paper gold market, I think, will contribute to the factors driving gold and silver prices higher. Now, I'd like to look very quickly at the gold and the near-term gold price. This is an indicator that I follow for gold very closely, for gold and silver, and it's the 14-week stochastic. It is a momentum indicator, and what you see is that we've come back a bit. And as my friend Ron Grease of the chartstore.com, who does these charts for me, notes in this comment, the indicator's on a sell signal right now, but if we can close at some point over the next week or so above $1,600, that's going to reverse to a new buy signal. So we're very close to reversing to that. And what I'd like to show you is that in a strong bull market, as you can see in the 2004, 2007 range, this indicator spends a lot of time around the 80 level or higher. And that's what we'd like to see. That's what I think we're going to see eventually. Also, back in the post-2008 period, we see a number of failures to go all the way back down to the 20 level. And I think if you look back at the parallels to that period, I think that's what's going to happen right now. We may have another week or two of consolidation of gold's recent rebound, and maybe more. Nobody can really predict the short term. The long term, I believe, is much more assured and clearer to see than the short term. But we may have another week or two of sideways consolidation before we see this stochastic show some upward momentum and get back toward the higher levels. I would like to end my presentation with one point of worry for me, and it's not a huge worry, but it is a bit of a nagging worry, and this is evidenced by this chart of gold versus Fed assets. Now, this is a chart that Ron at thechartstore.com did for me, and he rebased both of these metrics back to 100 at the end of 2008. Gold's in black and Fed assets is in blue. Now, if you look back around the summer of 2011, the gold price peaked. Operation Twist was enacted about then, QE2 ended, and gold traded sideways a bit as speculators waited for what next big move would be from the Fed, what the next big piece of news would be. And then in 2012, it peaked again and began to decline. What I believe happened then, and as you can see, right about here is in late or in September of 2012 is when the Fed announced QE3, which was the first instance of QE infinity. The Fed said it would purchase assets for as long as and to whatever degree was necessary to turn the economy around. Now, that should have been very bullish for gold, yet the gold price peaked there and declined ever since. Why? I think that speculators, again driving the paper gold market, were selling the news, and they looked ahead and they saw that the next big piece of news to come from the Fed would be the end of quantitative easing. So the gold price declined, and the gold price kind of predicted what we were going to see, which was the flattening out of the Fed assets and then the eventual decline. Now, gold bottomed in December of 2015 as the Fed began to actually tighten in in its halting attempts at normalizing interest rates. Gold bottomed then and then started to rise because it saw, I believe, that these efforts were going to fail. And then it really began to move in late 2018 because I think it was predicting and seeing again this great massive reflation and that would come, and that the unwind would be unsuccessful. So what's my worry here? My worry is that we've already gone to this QE infinity level. And the next bit of news will be the ending of that, or some or the ending of that, or some economic news that shows very positive growth. What I think we'll need to see this time around is some kind of real world bottom line economic effect of all this monetary easing. We will have to see some inflationary effects, or we'll have to see some depreciation of the dollar, and for gold to maintain that kind of upward momentum. So that's a necessary precondition, in my view, to get the kind of long-term bull market that we'd like to see. I think, all this said, I think we will see that. And I think one of the clearest indications the market will get in the near term will be the explosion of the federal debt, and thinking about and considering the implications of that alone, which are considerable. So I think we'll get that this time. I think we'll see after effects and real repercussions from this massive reflation. But that doesn't deny the fact that we'll have to see that this time to keep the upward pressure on gold prices. So very quickly, that's my contact information. And if you go to goldnewsletter.com/report, we have an investor's guide to gold and silver that you can get at no cost. So that is the end of my presentation. And I will hand over the, I can remember how to do that, change presenter to Eric. Are you there, Eric?
All right, Eric, we cannot hear you. I don't know if you can hear us, but we can't hear what you're saying.
Yeah. Okay. I had to mute myself. I just wanted to point out if you saw me disappear from the screen, I wasn't going to my bunker. I was trying to move the appliance is around to increase the bandwidth. And just for the record, I do not have the cheap package. I have the very expensive package. And I think today has cemented my decision to switch providers because I am not a happy camper right now. I pay a lot for internet to get bandwidth because I have real-time charts running all the time. And I think I'm going to be paying somebody else starting as quick as I can get a different box in here. I've got a bunch of questions here. Some came in earlier, some came in during the talks. I'm just going to sort of, if all four of us can have our mics unmuted, I'm just going to sort of pass the questions around. I've gone through them. I mean, I wanted to say in advance, I'm not going to get to every question. There's a lot of them. Some of the questions were effectively answered when people gave presentations. Because a lot of the topics people have been asking about were dealt with in them, but some of them maybe need a little bit of clarifications. They're mainly general questions. I think I'm going to sort of start. I'm going to start off with Gwen because Gwen touched on this topic anyway. But several people did ask the question that you did touch on, which was essentially the next leg higher. Should we simply be focused on producers and streamers? But the sort of attendant question that a lot of people asked was, is there any point to even paying attention to explorers and smaller juniors at this point? Or is this something where we just forget about them? And in fact, a couple of people asked, so is the game plan here that you just sell your early stage stuff and forget about it for 6 months and hopefully ride the wave with the bigger ones?
Sure, absolutely. Those are questions that are foremost in a lot of our minds right now. I will say, okay, so certainly we've all seen this playbook many times in any kind of emerging gold bull market. It's the producers that go first. We know how that top-down process works. And that is largely because when generalists rotate in, it's a lot of funds and they're big money, and they not only need to be able to take big positions, but they also have requirements around the scale of stocks that they can buy. And so those dollars, not only do they go to the big stocks first because those are the obvious ones, they're also the only ones that they can go to, that they can take big positions in. So yes, as the generalist dollars move in, the big players are the key, are the obvious tide to ride. So yes, for sure, I'm buying, Barrick, I'm buying B2 Gold, I'm buying stocks like that right now, Sandstorm, no doubt. I definitely think that when I say you need to devise your own plan, I think key to that plan is how aggressive you are as a gold investor and how attuned you are, engaged you are with the space. For those who are pretty engaged with the space, which I'm sure a lot of those listening are, there's going to be stocks out there that you really like, that you have been following for some time, where you think the geologic potential is particularly strong, where you think they've just started to delineate what will be a very big discovery, things like that. And I think if you just stick to the classic playbook of buy the big stocks and then move down into the developers and the optionality plays and then move down into the explorers later, there's a chance you could miss a very strong opportunity here because we don't know how this gold market will play out. It's possible that this gold market will just get started, right? That it will start to go slowly but surely from here. And if that's the case, you will kick yourself for having not bought some of those strong stocks that you love at these prices. There's, of course, also the chance that stocks get cheaper from here. So what I would say is, first of all, go back to that question that I asked, which is understand what kind of an investor you are. Not just trader versus investor, but what is the risk tolerance that you're comfortable with? Obviously, we've been sent through a crazy ride in the last few weeks, and so maybe that has impacted how much risk you're willing to take on right now, to the upside or downside. But definitely ask yourself how much risk you want to take on. If you're more aggressive and want to take on a bit more risk, think about the stocks that you really like, whether they're pre-discovery explorers, whether they're sort of explorers with new opportunities that you really like, whether they're, you know, outlining resources that you think have potential to become something really big. And you can either take advantage of current prices, or also in the chance that gold stocks get pulled down farther as the broad markets reach the bottom of the second half of this W, put in some stink bids. And I say do that now while markets are fairly stable, you know, relatively speaking, fairly stable, because you're not gonna, it's very hard to execute buy orders when things are falling. But if gold stocks get pulled down again to even lower prices and then rebound, you're gonna wish that you'd bought. So, I mean, look back at, you know, how low gold stocks got in the previous bottom just a few weeks ago. You can enter stink bids at those levels, but only do it for the stocks that you really, really love. As for whether you should sell explorers that you currently own, it might be a bit late for that. We don't know. Gold stocks may yet go down further. I just went through that. It may be a bit late to do that, but if it means the difference between having capital to rotate into the opportunities that we know are going to do well in the near term and not, then yes, you probably want to do some selling to make sure you have some capital, because making capital in the next 2 months, 3 months, however long it takes, means that you then have more capital to deploy into the next phase. So that was sort of a ranging answer. Hopefully I covered all the bases there.
Okay. I'm going to see, before I move to the next question, I'll see whether Brian or Jay want to add anything to this. The one comment I'm going to add, and it feeds into something people on my free list are going to get a little bit later. I had a conversation on the weekend with John Robbins, a guy most of you will recognize as a very well-known developer. He's had 3 or 4 M&A situations work out very well for him. And the reason why I talked to John, aside from the fact I've known him for 20 plus years, is I wanted to get his take at a very general sort of philosophical level. And I think he and I both agreed that as a rule in times like this, about the worst thing you can do is panic. It's hard not to when the markets are going nuts like this. But I think generally, you know, he and I both kind of look back on different bear markets we've been through, and we've been through a few. And, you know, we both kind of agreed that if you just kind of threw everything out the window at this point in the market, it's very psychologically difficult to buy back. I think one thing many people have found is when they sell on the way down, especially hopefully well on the way down, making the decision to get back in is difficult. The market starts to move and you go, oh, damn, I missed it. It moves more and you go, oh, crap, I missed it. And by the time somebody makes the decision to get back in the market again, they often find themselves paying more than what they sold the thing for. You know, this is with the good younger companies, the explorers. I don't know, do either of you have any thoughts about that, Jay or Brian?
I have some thoughts on that. I totally agree with that, Eric. And you know, one of the things that's really frustrating is we sit in here in this market for years and we look at the charts on a daily basis. We go on these emotional roller coasters, and then the generalists who just have the gold chart sitting up in the corner of their screen, one of their many screens, at some point they say, oh, that looks interesting and that's going to turn, and they get in and they make all the money while we've suffered all along. And we're so emotionally tied to all these little stocks, and you know, and they get out too, which we fight that battle as well. I completely agree and have been saying the same thing as Gwen as far as the developers and optionality plays, the development plays, and the producers being the first ones to move. And I've been advising that and not doing that on a personal level, because one of the things that I think we bring to the table, for better or worse, is that we know this sector, as Gwen also alluded to. We know these exploration stocks very closely. We know the people involved, we know the targets, we live and breathe it every day. So this is an inefficient market, and that's where knowledge can really be put to work. That's why I tell my conference attendees and subscribers and anybody interested in the sector that don't do it unless you're going to put in the time, effort, and money. Subscribe to a bunch of newsletters, go to a bunch of conferences, do the work. But we've done that work. You know, we do it daily, so we can take advantage of these inefficiencies in the market. And if we really know, when we're really confident in an exploration story, and all of a sudden it's selling for a third or less of the price it was selling as it was preparing to drill last summer. And you have a good feeling that in 4 or 5 months, things are going to be different or better, and perhaps even somewhat normal. And those are great opportunities right now. And that's the kind of things I've been personally buying in the market.
Okay.
Yeah.
I wanted to throw the next question to you, Jay, because you do deal with the dollar and its potential demise quite a bit. A question that several people had, and it's a good one, was okay, if you're assuming the dollar is going to have a big drop, or even if you think the dollar is ultimately going to go to zero, what's your alternative? Is there an alternative currency? Is there an alternative asset class where you think the money should go? In other words, if not the dollar, then what?
Yeah, no, that's an obvious question, and that's how they've kept the dollar as the world's reserve currency. I believe that part of the policy over the years was to intentionally gut the higher priced, so say value added manufacturing from the United States in order to orchestrate continuous trade deficits in the United States to ensure that there's a tremendous amount of dollars floating around the world. That serves our ruling elite, our military industrial complex, the government, the growth in those sectors, and it's actually hurt middle America, and the reason I think Trump was elected. So I think that's part of the program, but how does it, where would we go to? I know James Rickards, who will be on my show in a couple of weeks, has always believed that it would be something through the IMF, probably some SDR or something like that, but I think we'd have to see the dollar break down and things get so ugly. I mean, this could be the start of it with this COVID-19 issue. I think we're, when you see 30% GDP drops in a quarter, this thing is coming unglued, I think. And so, nothing is forever. I think the geopolitical aspects of this whole issue is not to be overlooked as well. We've got 2 hospitals that have 1,000-bed hospitals that are made for the military to take care of people, soldiers that are hurt, injured. 1,000-bed hospitals, one on the West Coast, one on the East Coast, with 10 operating rooms in each of those. I mean, these are facilities that are meant for battle. We've got the allies in Iraq that are walking away from our allies in Iraq that are walking away from that theater. We have a ship. I think we have some sailors now on a ship that are infected with the disease, and they don't know what to do. So I mean, I think this COVID thing could be, I think, a game changer geopolitically. It could be for currencies. Currencies don't last forever, but where would we go? I think that's the major question. I mean, there's no other currency out there that can immediately be the go-to currency, I think, and that's why the dollar keeps surviving for now. But I think this is very major what's going on now, and who knows for sure how it's going to play out. But I mean, gold could be a component of it. There's a reason why the Chinese and the Russians and adversarial nations to the United States have been building their gold reserves like mad. I think they probably see some sort of combination, as Rickards would suggest, through the IMF, a basket of currencies that would include gold probably. So I don't know how it's going to play out, but we know that countries don't stay on top forever. And we've had a run about as long as most of the other major reserve currencies going back to the Portuguese.
Okay. I'm gonna just quickly take a couple of the questions here myself, because I just want to get through them quickly. The others may disagree with my answers, and I'll check and see if you want to jump in. But 2 or 3 people asked about nationalization of gold silver mines, and I think they're mainly referring to G8 countries here: Canada, the US, Australia. Personally, I think that's an extremely unlikely possibility. There's no particular reason to do it. I think, a lot of people hark back to the late 20s, early 30s, when the US going on to the gold standard essentially made it illegal for individuals to own gold. I suspect I definitely have a couple of people on my screen that would disagree with me, but I think there's zero chance we're going back to the gold standard personally. So I don't think that's going to be an issue. I don't see any particular reason why they do it. Several people also asked about You know, is it an issue? What does it mean that Russia stopped buying gold, or announced they were going to stop buying gold a couple of days ago? I think it's just something Brian and I talked about the other day, and yeah, it's essentially in Russia, and this is true of several countries. Uh, the Russian government, the Russian mint, if you will, buys all of the gold that's produced in country. That's the way their system's done. Uh, my suspicion, I suspect Brian's in agreement, is that they're doing that in this case to allow citizens, if they so desire, access to that bullion. Because when you think about it, there's really no reason why the Russian mint, or any other mint for that matter, which is part of the government, would stop buying gold, because all they really do is print currency, or actually do a few keystrokes to create the currency and then buy the gold. It's a no-lose situation for a mint. So my assumption is the reason why Russia is doing that is to actually allow Russian citizens, if they so desire, to buy it because of the current retail demand for it. I don't think I would read any more into it than that. It's not I don't think it's a matter of Russia changing its mind about gold. I think they're just trying to allow citizens access to it. I'm gonna, if one of you wants to jump on either of those, you can. Otherwise, I'll just move on to the next question. One of these, and this is something, I think this is something we all touched on a little bit in presentations. And I think I'm maybe going to throw this one at Brian. And that's, are you concerned about the deflationary impact of the current situation? Right now, we're in this sort of deflationary spiral as everybody's throwing everything out the window and selling everything they can. Does that, and a couple of people reference the oil price in particular, which of course has fallen apart. Does that deflationary impacts, at least short term, does that concern you when it comes to gold, or is that something that gold's simply going to ignore in this market backdrop?
No, it doesn't really concern me. Gold, it is affected over the short term, but one of the things that I learned very early in my career, really learning under Jim Blanchard, was that central bankers are raised from their mother's womb just abhorring deflation and will do anything they can do to avoid it. And they can, and they do. And they have a huge weapon, the printing presses. Was it Ben Bernanke or Greenspan, or both? Ben Bernanke, I think, the one who said that. And so, yeah, they can defeat monetary deflation by just creating ungodly amounts of money. They have that power to do that, and so you can have a deflation, you can have short-term issues, but eventually they are going to create so much money that they will overwhelm those trends, at least as it relates to monetary value. There's another old saying in trading that a country has an uphill battle, if not an impossible battle, to build the strength of its currency, but it has all the power in the world to weaken its currency. And when they want to do that, they can do that. The only central bank I've ever seen that I've ever had a challenge in doing that was the Swiss National Bank. And so the U.S. can do that. And in regards to gold and preserving purchasing power and gold as insurance, and even the leveraged ways to play gold with mining stocks and the like, as we saw in the charts in these presentations, in the Depression, FDR devalued the dollar by 69% by keeping it attached to gold and then raising the gold price after he had confiscated the gold from American citizens. So the government, the central bank, can do that. And if you're in gold, you will be protected. And even if you're in mining stocks, you'll have some leverage to that move. So I'm not really overly concerned. I expect deflationary waves to come through, but the reaction and the response, the policy response from central bankers has always been the same, and it will be again.
Okay, our time is getting long here, but I just want to touch on a couple of very sort of, I guess, simple questions, and they're sort of related, I guess. And this one's for any of you, really. Do you have preference right now for gold or silver? Which one do you think does better going forward? My personal preference tends to be for gold. I appreciate the concept that silver percentage-wise should have bigger gains, But I recognize that, you know, like it or not, if you're a silver bug, I think the market treats silver as a more industrial metal than gold. That's just, I think the way it's reacted in the last month tells you that. The other associated question, and Brian and Jay have both kind of touched on this, and I think Brian and Jay probably follow these things more than perhaps Gwen and I do. It was a question about, are there, you know, paper gold vehicles that you feel any comfort with? And the one that was asked about particularly, and there's 2 or 3 versions of this, was a Sprott Physical Gold Fund. I mean, that type of fund where you're basically buying a unit in a fund that owns bullion on everyone's behalf. Do you feel good, or do you not trust those? I mean, anyone got any thoughts on either of these?
Yeah, I think,
Jay?
well, I think, yeah, the Sprott, I think, is a safer way to go than GLD, for example,
Right.
Because of the prospectus and what's in there. But yeah, I don't think GLD really has to cover you. I don't think they have to have, and I don't think they do have. As a matter of fact, you certainly can't get your gold out unless you're a large trader from GLD. There's another one, OUNZ, trades in New York Stock Exchange, and that is a vehicle which you can actually take the delivery from. It's his name, Merck. I'm trying to think of his first name. Anyway, huh?
Is that Axel Merckx?
Yeah, Axel Merck. It's Axel Merck's company, and OUNZ is a symbol. I have never tried to take gold out, but I know that's you're supposed to be able to do that. So it's there for you, supposedly.
Thoughts, Brian?
Yeah, I like silver because I don't think it is an industrial metal. I think if it was valued on its industrial usages, and because it's a byproduct largely of other metal production, it would trade for under $5 an ounce. But perception is reality, and that's why the metal was so viciously sold off. Whereas we looked at the economic abyss, investors looked at the economic abyss lying ahead. They sold off silver because of that modern fallacy that it's an industrial metal. And I look at that as an opportunity then at these kinds of prices, because I do think it will outperform gold on the upside in a longer term monetary based bull market. But you should be diversified because frankly, what do I know? You know, the market ignores my views, and over the short or even long term, it's all a guess anyway. An educated guess, I guess, nonetheless.
I think both is probably a good answer. Have you got any thoughts, preferences in terms of one metal or the other, Gwen?
Yeah, I'm sorry. Go ahead.
I prefer gold, but I think one of the things that we always have to be careful of as investors is just being aware of our own preferences, making sure they have any grounding and questioning them all the time. And so while I intrinsically lean towards gold, I'm aware of that, and so I try to make sure that I also have some fairly strong silver exposure in my holdings. And so, yeah, so I think that's how I balance that, because silver reliably does all of those slingshot outperformance things that we referenced just then. It reliably does those. So I think it makes sense to have exposure to both for sure. And yeah, in general, to be aware that you shouldn't just put all your eggs in one basket or the other, because we are in unprecedented times, so we don't know how this is all going to play out. So I think both make sense.
Good. And do you, I might have cut you off there, Brian, do you have any preferred vehicles in terms of getting market exposure to gold or silver?
Yeah, about the only paper representations that I recommend is a Sprott Physical Bullion Trust, are the Sprott Physical Bullion Trust, because the holdings are allocated. Your gold is set aside and labeled for you, which is an important step. The other thing is, for U.S. investors, at least, there are some very real tax advantages through a quirk in the U.S. tax code. Of course, consult your own professional advisors, yada, yada, but there is a significant tax advantage there. And actually, I was talking to someone that I guess I'll keep them anonymous, but they were telling me that Eric Sprott was explaining to them to this person the structure of the bullion trust. And this person asked Eric, wouldn't you make a lot more if you're able to loan out some of that gold? And he said that Eric nearly came over the desk at him. said that. So I think that's ingrained in the DNA of Sprott, that is those trusts are held in trust and that it is allocated and it is your goal. It's really the only paper representation, as I say, that I truly trust.
Okay. On that note, I'm going to call it a day. This is run fairly long. I want to apologize again for my audio, and I'll try a headset next time. But as Gwen mentioned, I got a feeling bandwidth is my problem. It's not. I don't think it's the laptop. It's bandwidth. So I'll see if I get that fixed before the next time. This is being recorded. MIF will make this recording available ASAP. There'll be a little bit of jumping around to do, but we will load it up somewhere and we'll send a link, of course, to all of you and probably out to the MIF attendee list so everybody can get access to it. Thank you to the three of you for being here. Thank you for the audience for being here and putting up with some of our technical difficulties and the length of this. And we'll probably see you all again soon. This is going to be a bit of a shit show for a while, I think. So I got a feeling this won't be the last time we get together and go, okay, now what the hell did we do? On that, I will call it a day. Thank you very much, everyone.
Thank you, Eric.
Thanks, everybody.